If you're starting a new business, lenders and investors need to see a business plan and a financial forecast. Without them, you won't get the money you need to be successful. At ForecastProfits.com, you can get our free business plan guide. But more important, you can get our financial forecast template, which will generate sophisticated financial statements including cash flow, income statement, and balance sheet. The following is a brief overview as to how Forecast Profits works. I'm going to share my screen with you so you can follow along. Our mission was to create a user-friendly business tool so that you can operate. You don't have to be a CPA or having been a business major to understand and operate how to create sophisticated financial forecasted statements. We want to assist you in understanding how your business operates financially and be able to anticipate tough questions from lenders and investors. If you want to frustrate me, give me a complicated instruction manual where I have to go back and forth between the manual and the actual template to figure out how to complete it. We've eliminated that. The only thing you need to remember are 3 simple rules. Number 1, you enter data in yellow shaded cells on red tab sheets. Number 2, there are 4 different ways to generate revenue. You can use one or any combination of all 4, which will fit most business models. Next, on the spreadsheets, you will often see a red triangle in the upper right-hand corner of a cell. Drag your cursor over the cell, and a definition will appear or important instructions on what to enter in that cell. Finally, the green tab sheets display your projected financial statements monthly, quarterly, and annually. Our first case study was with Helen, who created her own business, Helen's Home Health Care. She was a geriatric nurse for 15 years and decided to leave her employer and start a new business. The first thing Helen had to accomplish was she needed to purchase some assets to operate her business, office furniture, software, etc. Now, as we drag our cursor over the first cell with a red triangle, it gives us the definition of 2 different types of assets. Next, we assign the revenue model to how these assets are depreciated. In this case, it's number 4, billable hours, because service providers are going into seniors' homes and charging for their time. Next is the month the asset is purchased, and finally the purchase price. Note that we have allowed for expenses that you would incur before the beginning of operations. In this case, organizational expenses, which are amortized over 5 years, and your financial statements. That could include legal and accounting expenses, as well as office rent before you begin operations. The same rule applies to research and development if that applies. Next, let's go to the revenue model that these assets are assigned to, billable hours. The model will take into account all payroll deductions that are necessary levied by the federal government. In this case, you need to do a little bit of research to know what the unemployment compensation rate is and the workers' compensation rate is in your particular state. Note that there are some cells that have a red border around them. You need to insert a value in one of these cells or you will get an error message. Now to the direct revenue and direct labor costs. Helen's first employee, W-2 employee, is care provider number 1. She's going to charge the client $40 an hour, and maximum billable hours will be 35 hours a week because they're never 100% efficient. It's going to take about 3 months for that employee to get up to speed to be 100% billable hours, and finally a 3% annual increase. The direct labor cost for that employee is paying that employee $18 an hour over 40 hours a week with a 3% annual increase. 5 rows of numbers follow. This allows you to enter when an employee is hired monthly over the period of the next 5 years. Not all of Helen's employees will be W-2 employees. In this case, a physical therapist she plans to hire and pay bill 45 hours to her client, but they'll only work part-time 20 hours a week. And she will pay that independent contractor $30 an hour. 20 hours a week. In this case, the independent contractor is responsible for their own payroll deductions when they file their taxes annually. Note in the second row, you can designate which month independent contractors are hired. Next, let's go to asset recovery. Helen plans to rent equipment to her clients, which include hospital beds and wheelchairs. We enter the month that each of the assets are purchased and the purchase price. This is all transferred to the asset rental spreadsheet. It allows for many different number of assets that you can include and what you charge on a daily rate, the annual increase, and the number of days that you're renting the asset. Now, this model would be applicable as well to a manufacturer who may want to charge back equipment time to specific customers by estimating what the equipment utilization is as the business grows. In this case, maybe that the first month you're only getting being able to operate that equipment and bill to a customer 6 days a month, but as time grows, you might be able to bill back 25 days a month. In this case, we did not create employees for this particular revenue model because there isn't very much labor required to rent the equipment. That can be scheduled by the office staff. Next, let's go to operating expenses, where you can enter typical operating expenses for your business, and note that you can enter what the initial cost is, the first year's quarterly increase, and then annually after that. Now remember, you don't have to make every forecast a 5-year forecast. You can make this a 3-year forecast by only entering values up to 3 years. Just remember that when you print your financial statements, you designate the print area for the first 3 years. Below is the overhead or office staff, their annual salary, month they're hired, and you need to designate whether they are a W-2 employee or an independent contractor so the model knows whether to take the payroll deductions from their paycheck. As I indicated earlier, not much labor is required to rent the equipment, so we've allocated only 10% of the operating expenses to the asset rental revenue model, and the rest is to billable hours, where it's more labor intensive. I want to go back before we get to financing to the other two revenue models, which I want to make a brief comment about them. Product sales would pertain to if you manufacture a product or purchase a product and mark it up for resale. We have the same typical payroll costs, but there is an allowance for many different products, and you can indicate what the unit sales price is per month and the number of units sold, and how the sales price increases. And under direct costs, you can input what the direct cost is per unit, and you also have the ability for many different job classifications or descriptions assigned to that particular product. Next, the one that I want to cover is recurring charges. So many businesses started today are over the internet, where you charge a subscription or monthly fee to your client. Now, most businesses are month-to-month fees. So it's important that you know enough about your business of what your churn rate is as you acquire new clients, because clients will join for a few months and then leave. And so it's very complicated to calculate what the net revenue growth is. So you need to estimate the number of clients you acquire by month, but it also, in your churn rate, the number that will leave each month. The model calculates what your net growth rate will be, and you can, of course, add several different monthly charges and below create direct labor costs. Now let's go back to the last item, which is financing. This will calculate the amount of operating capital that you need during the term of the forecast to operate your business. Note the first box we fill in is the number of months we anticipate it will take to recover the operating cost. We're going to enter 60 months and note that up above, value is automatically generated of what the estimated working capital is required to operate your business during the term. Now, this is an iterative process that's explained in steps below here, but essentially what you do is go through and match these numbers. And in this case, Helen anticipates that she's going to put in 25% equity. She doesn't need a third-party investor, but she's going to borrow 75% of those costs. She needs to match what the equity would be, and the interest rate will be 6%. Now you notice that these numbers here do not match. So we go through a process of changing these two numbers until we get a match or close to it. And that's what this process describes. I'm going to jump to the end and put the actual value in for the sake of expediency. Now you know how much operating capital it's going to require to operate your business during the term of the forecast. This is now automatically incorporated in your forecast, which includes principal and interest payments. Below, you can enter your marginal tax rate, both federal and state, which is also included in the forecast. The financial statements are expressed monthly, quarterly, and annually. So I'm just going to take us to the annual financial statement. First is cash flow. One thing the cash flow statement does, it does take out taxes, your tax liability for profits you've made. So that's automatically calculated. So, and you can see what your net cash flow is. Here in this case, it's stated annually. Next, we'll just go to the annual income statement. And you can see that we have four different revenue models again, but Helen has only utilized two of them. And we get to the end, which generates your net income. Finally, the balance sheet stated annually. And this will indicate how your business is growing in value, as you see here with total equity. And that's how the model operates. And these are the statements that you would include in your business plan to give to your lender or investor.